Welcome, everybody. My name is Mike Fiffick, and my law firm is Fiffick Law Group here in Pittsburgh, Pennsylvania. We have an office in suburban Philadelphia as well. And we are welcoming you to another one of our webinars. Diane Scabilloni from FNB, First National Bank, is here. She is a mortgage expert, and she's going to share all kinds of great information about lending, especially in this time of higher interest rates. We have had some recent ripples in the banking market. Maybe she'll comment a little bit about that as well. But it's just a great time, as always, to be thinking about if you're going to be buying property, buying a home or a townhome or anything like that in the near future, to be having sort of an insider's view of how the bank looks at you, what their approval process is, and how you can get a leg up or get some advantages to facilitate your opportunities to be approved for a loan to buy real estate. And it's really a great time because it's competitive out there for properties. You hear of so many folks putting bids in on properties, and there are several at one time. So having your ducks in a row, having your loan commitment in hand may give you an advantage over other buyers out there. So I think Diane's advice that she's going to share with you today is going to be even more time. So with that, I'll hand it over to Diane. Thanks.
Thank you, Michael. I appreciate it so much. I'm so happy to be here. So yeah, I have my slides here ready, and we're going to talk about what does a lender look for when approving a mortgage loan. So the first thing is just kind of like, here's the basics. This is what happens when you look to get pre-approved for a mortgage. These are the minimum things that you're going to be asked. A lot of times we can do these things with you on the phone, but it seems now with technology, most lenders, I know we have a really great app that we just direct you to, and you can just kind of fill in the blanks. And we're so used to going to computer screens nowadays and filling stuff in. Customers can do it a lot faster than me, but these are the things that they're doing. We need your name, your social security number, your address, and your date of birth. That all allows us to pull your credit. And then we need your income information. So we need to know, how are you going to pay this? You know, what's your source of income? And then we also need to know, how much do you have to work with for a down payment and to cover closing costs? So those are kind of like the bare minimum basics of what we're looking for. And so basically, the most important factors that any lender that you talk with, I mean, obviously, I'm here representing First National Bank and would love your business, but there's lots of other lenders out there. I've worked at other companies in the past. I've been doing this for 20 plus years. So these are all the things that lenders are looking for: your willingness to pay your debt. So we're looking to make sure that you're able to pay it. So that's obviously by looking at your credit report. That's a really key, important piece to this puzzle, which we'll be talking about. We're also going to be looking at your ability to pay. Do you have the money to pay it? Do you have the source of income to pay it every month? That's what we're looking for. And we're also going to be looking at, what is the collateral, the property? What kind of condition is it in? And so it's all about lenders' risk. That's what underwriters do whenever you're going through the pre-approval process. You know, someone like myself as your mortgage banker is going to be looking at these things and having conversations with you about this. And as you know, as you've been paying attention to, the news with the banks that are having some issues, maybe their risk was a little bit too high. And so this is what we're looking at, is what is the risk. So credit, this is the first part, willingness to pay. So I love this chart. This makes it so easy to understand. Why is it difficult for me if I have a score below 600 to get approved for a mortgage? Well, based on statistics, and I've had this little spreadsheet for a while. I'm not quite sure how much it's changed, but the default ratio. So if you go into get-go, or you go into Whole Foods and you walk around, if there's 8 of you in the produce section and you all have 600 credit scores, one of you is likely to foreclose on your mortgage. So that is definitely a much higher risk for lenders. Then if you have someone that is in the braggy overachiever mode of having it over an 800 credit score, the chance of those people, 1 out of 1292 is likely to foreclose. So that's, that's the difference where lenders are really looking at. And then the other thing for you to keep in mind is the different rankings. And as you can see, like the gap, I mean, the difference between a 760 and a 799, it's just very small little margins. Now, this is, especially for conventional loans, these little margins could give you a different interest rate. So if you have a 700, the chance of you foreclosing is 1 out of 23, you might end up with, and I'm just throwing numbers out there, not an indication of rates or anything, but you may be sitting there and be offered a 7% rate, where maybe someone with an 800 would be at like 6.75. So there's just want you to be aware of keeping track of your credit, and having good credit scores is huge. It really makes a difference in your ability to purchase a property. Then the part how they determine your credit scores is, it's not just, people a lot of times will think, well, I pay my bills on time, what difference does it make? But look at, on this chart, it shows that only 35% of your score is factored in by what your payment history is. The other thing that is really a big deal right now is your credit utilization. That's 30%. So what that means is, if you have credit, let's just use credit cards, for example. And if you have, say, $10,000 of limits on your credit card, and you're at 9,500 is your balance, your score is going to be a lot lower than someone that only owes maybe $2,000 or $3,000 on that $10,000 limit. So they look at your utilization. How do you manage your credit? And they look at this because we're really in a society now that doesn't have a lot of money saved. So we're looking at credit cards, and having balances is almost like unfortunately, like a little bit of a security blanket. So do you have access to cash if you need it? And if you don't, then that is going to give you a lower score. And then, folks on the call that might be younger, your credit history is 15%. So, say someone in their 20s is going to have probably a lower score than maybe someone in their 40s or 50s, because you just have, you don't have as much history. And the type of credit that you use, that's another factor. If the only debt you have is credit cards, you may have a little bit of a lower score than somebody that kind of knows how to maneuver in the credit world. They have a car and they have a car loan. They may have, some credit cards. They may have a mortgage, just kind of like knowing where to go whenever you need to borrow something, going to like the appropriate source instead of maybe buying a car on a credit card or something like that. I know that sounds kind of crazy, but that's why it's only 10%. And then inquiries. I know a lot of times I get this question all the time. How is this pre-approval going to affect my credit scores? It will. Because most lenders, if they're going to issue a pre-approval, they're going to pull your credit report. If you want a real legit pre-approval, which a realtor is going to want whenever you go to make an offer on a house, or even to show you a house because it's so competitive. But you need to have that, and it could affect your scores by maybe 10 or 15 points. But within 90 days, all things being equal, you'll get those points back. And what you'll want to do, because I know a lot of times people are going to want to shop around, even though I love them just to stay with me only. They may talk to other lenders, and that's perfectly fine and encouraged. And so what happens is, What you want to do is try to talk with different lenders within like a 2-week window, because what happens, the credit reporting agency only sees that as really one inquiry. So that 10 or 15 point hit, even you could have 5, 10 people all from the mortgage industry diving into your credit report within a 2-week period. It's only going to affect your scores by 10 or 15 points usually. So, and that's all things being equal. You don't want to be trying to buy a car at the same time and open up a credit card. Then it's really going to cause some havoc with your credit scores. So you want to just be really strategic and plan this out. And I'm encouraged that if anybody is on the call that, maybe you're not planning to buy something for 6 months, a year, this is perfect. You want to know all this stuff now. So next on the screen here, let's see what we got. The ability to pay your employment, your source of income. Here's the basic general things that we need: at least 2 years of work history or education. So if you are just graduated and you just got a degree and you only been working on the job for 6 months or for a year, but you're working in the line of work where you got your education, that counts. You're good. Same line of work is really preferred. So you can, a lot of times I'll have people that are kind of transitioning, they're getting, they're moving up. As long as it's in the same line of work, that's perfectly fine. Any gaps of employment, that's where we have to be pretty cautious. We want to make sure that it's been pretty steady. So if you work somewhere for 3 months, you were off for 6 months, work somewhere for 3 months, off for 6 months, they're going to have a little bit of an issue. They're going to want to see you to be a little bit more stable. And they'll want explanations about what it was, if it was an accident or, health issues, if your job is stable, like a salaried position. Those are things that we look at and we'll explore. We would just need letters of explanation on those things, and sometimes verification. We will be doing written verification of employment, where we're going to contact your employer, just to confirm. We're going to get pay stubs and W-2s to verify all of these things. And then even right before closing, we will call your employer to make sure you still work there. Believe it or not, sometimes people quit their job right before they buy a house. Don't do that. It's not fun for anybody. And if you're self-employed, which is great, but we need a 2-year history, and we're going to look at, just be aware that we're going to look at your net income as compared to your gross receipts. We have to take into account any expenses that you tell Uncle Sam about. And, we're just looking at likelihood of your employment continuing, your line of work and trends. And those were all big issues that we had during COVID, which now hopefully all of that is behind us. So evidence of this income and evidence of your ability to pay. As I mentioned before, we're going to want to see 2 most recent pay stubs, 2 years of W-2s, 2 years of tax returns. So we work with a lot of physicians. We're going to want to see a contract that you have of starting your new position. All of that documentation. Gone are the days years ago where things were like stated income and we just have to verify everything. And sometimes it feels like we're looking at the same thing 3 times. We are. Just bear with us. Just bear with us. There's so many rules and compliance and regulations. Don't shoot the messenger. Just understand that these are all the rules that we have to follow to avoid things that are like happening in the news right now. So how the income is calculated is incredibly critical. Someone that works on straight commission, we need a 2-year history. Someone that is working part-time, we need a 2-year history. Is unemployment common in your line of work? Maybe you do a lot of outside work and this time of year you're home, but then you're killing it from April until January. We just want to see a history of that unemployment continuing. And a lot of times we can use it as part of your income. We're going to look at, like I had mentioned before, your business returns. We look at the net, not the gross. So if you're planning to buy and it's tax prep time right now, and your accountant is like, look at all these write-offs that you have, we can show that you make $2,000 a year and that's all you have to pay Uncle Sam. But remember that $2,000 a year is what we have to count for income to be able to afford a house. And you're not going to be able to afford a house on very much house on $2,000 a month. But if you receive K-1s, if you have a corporation, all of those things, we're going to be exploring and needing 2 years history on all of that stuff. Even like profit and loss are things that we're going to need to explore. So next, the ability to pay also includes your assets. We need your 2 most recent asset statements, especially for any accounts where the money is coming from for closing. If you have a little credit union account with $20, that doesn't matter. But, anything else, where is the money coming from? We need to see, is it your money that you've had in there for a while? Is it gift money? This is the part where it feels so incredibly intrusive for people, and I'm apologizing in advance. We have to follow the laws of anti-money laundering. So we are going to ask, I see you just deposited $2,000 in your bank account. You make $3,000 a month. We need to know where that came from. We just have to document those things. And you say, I didn't even put it up yet. We need to explain large deposits, paper trails, transfers. We need to know, have it be in your name. Is it a shared account? If it's a shared account with a parent, or sometimes we'll end up needing a letter from that person on there that says you have full access to that money. You can borrow against your retirement. So anything that you have that has collateral, like your retirement account, you can take money out of your 401k. As long as your employer allows you to do that, you'll just want to make sure that you provide all the documentation. So document. Is the money seasoned? So in other words, we're going to look at your 2 most recent statements. So if you put money in there that you got from grandma, she gave you $20,000 at Christmas time for a house, and we just look at 2 months of your bank statements and it looks like you've had that 20,000 in there, then we don't need to source anything. So it's really nice if you just have, if you have any types of activities that may be questioned, just try to get that out of the way. If you have mattress money, like in other words, cash under your mattress, get that in the bank, because we can't count cash. I mean, I have so many times people are like, I have $5,000, I get tips and I've been saving that for forever. We cannot count it. So, if you're planning on buying a house 6 months from now, get that money in there so we don't even have to question anything. Sometimes what we look at is that you have at least another 2 months of what's called PITI, which is principal, interest, taxes, and insurance. We want to make sure that you have, like, say your mortgage payment is going to be $3,000. We want to see that you have an extra $6,000 in the bank after closing, just in case you have, in case of any emergency. So that can be like retirement or, any kind of extra cash, that any savings accounts that you have. And it's always a good idea, like if things are tight with any other areas for qualifying, putting more money down a lot of times will help, and showing that you have reserves, that you have someone that has $300,000 in a retirement account looks like a stronger candidate than somebody that has $10 left in the bank after closing. So those are just some things to keep in mind as well. And seller assistance can definitely help you with your funds to close. It's a little bit of a challenging market right now where you have competitive offers. So it may be a little tough to get the seller to pay your closing costs, but I've seen it happen. It can be done. So that can help as well. And that just varies depending on the loan program you do and what type. So I know I'm probably flying through this. I'm hoping that it's it's okay. All right. Current debts. That is again a factor in your ability to pay. The standard ratios, what that means is the 35% that represents, I'm just going to like make this really super easy math. Let's say you make $1,000 a month. 35% of $1,000 would be 350 bucks. That's how much you can go up to for a house payment. That means principal, interest, taxes, and insurance can't be more than $350. The 45%, what that represents is your house payment and your other bills, which is revolving credit card debt, which I think we'll go into here. Revolving credit card debt, car loans, student loans, all of those things. So that means like 450 bucks, which is 45% of the $1,000 we're using, is how much you can have for all of those things. Sometimes we can't even go up to 50%. And this is based on your gross income, not your take home pay. So you want to be cautious that, you know, if you make $1,000 a month and 50% of your income, you know, is going for your house and your other bills, that means you only have $500 left for taxes and, you know, in terms of whatever personal property taxes, not property, but you know, your personal taxes and all that stuff. We all know that our net pay is a lot less. So you want to keep that in mind. Some of the things that we look at is we'll compare your current housing expense to what you're requesting. So if we know that you can swing it, say you're paying $1,500 a month in rent, you're buying a house where it's, you know, $1,800, that's a lot easier for an approval than someone that maybe is still living at home, has never had housing expenses, and we're going all the way to, you know, a big chunk of their income going for a housing payment. So as I was mentioning, we'll include your installment debt, revolving accounts. What we use for the revolving accounts is just the minimum monthly payment. So if you normally pay, like say you have $1,000 on a credit card bill, and you normally pay $100 a month to get it, you know, to pay it down. But the minimum payment's only 20 bucks, we only count the 20 bucks, which is a good thing. And then in terms of student loans, I know that has been like just a crazy hot button right now. And a lot of people are still not in repayment. What we have to do from a lending perspective, kind of like a general rule of thumb, if you have questions on this, you'll be able to contact me personally and we can go through this together. But generally speaking, we'll take 1% of what your student loan balance is. So say you have $50,000 in student loan debt, then we would consider you having a $500 student loan payment. If you're in like one of those income-based repayment programs, then we can look at what that payment is. We just need to see the paperwork, so documentation. Like I said, minimum monthly payment on revolving. If you happen to be a cosigner on any loan, so if there's anybody out there that's on here that's like, hey, I want to buy a second home, I'm really curious about this, and you cosign for your kids for their student loans, we need to count that debt as yours. We might be able to get away with not having to, as long as we can prove that your kid's been making the payment for at least 12 months. So again, call me and we could talk about it. If you have alimony payments or child support payments or separate maintenance, that has to be factored into that 45%. And it has an impact on how much of a house you can qualify for. So again, this is something which we could have a completely separate conversation. I know we had talked about with people going through a divorce, that this is an important factor to keep in mind of how you write up your separation agreement in terms of, is it calculated as child support or alimony, how old your kids are. There's a whole thing about that. So just keep that in mind. It's an important factor. And then also, if we pull your credit report and you think, oh, geez, they pulled my credit report, I'm going to close in a week, I'm going to go buy that, you know, I don't know, washer and dryer, I'll do the 12 months same as cash and, I'll save on the interest. We pull your credit report right before closing. So you don't want to make, once you've been pre-approved, you really don't want to make any changes at all unless you talk with your loan officer, because that honestly can have a big impact on you right before closing. Let's take a quick sip of water here as we're going.
And just so everybody knows, Diane, I posted a couple of links in the chat. You can apply, you can get a free credit report once a year. So if you haven't had a chance to take a look at your credit report, it's a good idea to order that, take a look at it, see if everything on there you recognize, right? I just talked to somebody this morning that said that dealing with a wage garnishment over some account that they don't recognize. It was from a long time ago. So that kind of stuff does happen. The things will show up on your credit report that are errors, and you can dispute things that are on your credit report. And I provided a link to the Consumer Financial Protection Bureau, the federal government, that has lots of great resources on those types of things. So you can be a little bit in control of what's on your credit report and how you look from a credit profile perspective. It's a good idea to take a look at that. Those things have an impact on other aspects of your life too, not the least of which is your auto insurance rates, right?
Yeah.
Auto insurance carriers oftentimes will take a look at your credit reports in order to assess whatever your rates are going to be. So it's definitely something that's a smart thing to look at from time to time for all consumers.
Yeah, Michael, that's such a good point. I mean, even employers are looking at that now. Certain industries, they're pulling credit report. And then just keep in mind, I'm glad you had mentioned that, because if you get a credit score like on your Discover bill, that doesn't necessarily indicate what your credit score is going to be when we pull it from the mortgage perspective. The factors that I showed you with the 30% and the 35% and everything earlier, that's kind of like the breakdown from the mortgage perspective. If you need, I think when you look at your Discover bill, that might just be the credit scores in order for you to get another credit card or something like that. So, just don't be insulted or upset if, your credit card says you're a 740 and then you come back to someone like me and it's really a 720. It's just a whole different thing. And that's why it's good, like Michael's saying, to investigate it even more. And it's never too soon to get pre-approved, to get it looked at. So keep going.
Fire away.
Okay. All right. So the value of the property, that is a very important piece of this too. The appraiser is going to go out there. Very rarely is there a drive-by only appraisal in the mortgage world. And they're going to compare it to similar homes in the area to make sure it's worth what you're paying for it. And knock on wood, we've been really, with the market increasing, in the last few years, at least here in Pittsburgh, and, values are just going up and up. We really haven't had too much of an issue with that increase. Values have been coming in, really right there with the purchase price. So that, that's a good thing. The appraiser is going to note any items of disrepair, and will let us know. We haven't run into that so much lately, at least I haven't seen that, but if the appraiser goes out and there's like shingles flying off the roof, they're going to take a picture of that, and there'll probably be like a roof certification that's going to need to be done. And before we'll lend on that, I should say. And, if you have a minimum down payment, sometimes they're going to be a little bit more picky than someone that's putting like 50% down. So just keep that in mind. And I know that most people, when you can do it in the negotiations, I'm a big advocate of having a home inspection, unless you really know stuff about houses. And it's a good idea to get a third party to give you kind of the thumbs up on the furnace and the air conditioning and all of those things.
Yeah, we get calls constantly from home buyers who bought the disaster home that has all kinds of problems. So you definitely want to get a home inspection done by a certified home inspector, not just cousin Joe, who happens to be a, somebody that does work on Craigslist every once in a while. So definitely there are certified appraisers, or not appraisers, but there are certified home inspectors that do a professional job, thorough job. And, you want to ask questions and be observant about what you're seeing. And look at those property disclosures that homeowners provide to you, like really read them. If there's anything not filled out, missing, looks weird, you should be asking questions about those things, because it's much easier to deal with ahead of time than it is after the fact. Very difficult to do it after the fact. So,
Yeah. No.
Diane, I have this question come up every once in a while about appraisals, right?
Yeah.
Some folks will say, well, the seller just had an appraisal done of the property last year. Can the bank just use that? And my answer is always no, right? That's
It's
right.
always no. It's always no. Yeah, I mean, again, there's such tight rules and regulations because of what's happened in the past that we can't even say, like back in the day when I started in this industry, it would be like, hey, call Joe Blow, he's going to do the appraisal. Or I could call him and say, I have a customer that wants to refinance and they want to take cash out. Do you think there's value enough for them? The appraiser's going to come in and X. Can't do any of that anymore. We have to even send our appraisal requests to an appraisal management company, and then they will churn and decide on who is going to do that appraisal report. And even the report expires after 120 days. So yeah, because the market changes so much.
Yeah, it does. Are you going to be talking about PMI later on or no?
A little bit. Yeah.
I was just going to say, on the topic of appraisals, right?
Yeah.
If you have a loan, if you bought a property and you're required to have to pay mortgage insurance, because property values have been going up, right? It's sort of a good time to maybe get an appraisal, because your equity may have increased such that you're no longer required to continue paying that PMI, which can free up 50, 75, 80 bucks a month for you. You otherwise don't have to pay for several years, right? So just.
Yeah, no, that's excellent advice for sure. Yeah, I mean, normally if you have a conventional loan and they want to see that you have a 2-year history, and again, it depends on the market, but it never hurts to ask. But normally they want to see that you're paying on it for 2 years and you've been paying in a good, timely manner. Then they will say, let's get an appraisal and see what the value is. But now I think it's worth asking. And, sometimes they might not even want to report if the values have increased that much dramatically, or if you're one of those people that pays extra on top of your regular monthly payment. They may just look in the computer. They have all these appraised value models and computer programs that they can kind of go in and maybe just say, yeah, we need this house to be valued at 400,000 to get rid of the PMI. And, according to all of our calculations, it's worth at least 4.25. It doesn't hurt to ask.
Absolutely. Right. Otherwise, you don't ask, you'll keep paying.
That is so true. And, like you said, 50 bucks a month, 100 bucks a month. Geez, oh man, it $7.29 for a bag of sweet potato French fries at the grocery store. It works.
Absolutely.
All right. So
might get you a dozen eggs.
Yeah. Right. Gosh. Okay. So types of loans. We'll talk about conventional right now, conventional conforming loans, standard 5% down. However, there are many lenders out there have special first-time homebuyer programs. We at FNB, we do have a 0 down program. Sometimes it depends on your household income, and sometimes it depends on even where the property is located. So that is an amazing product that we could talk about specifically for you. Generally speaking, if you don't qualify for those 0 down programs, there's definitely, if you're a first-time buyer, the minimum is 3%. So I want to say this very clearly, that it is not minimum of 20% down. It baffles my mind how some people still think that you need 20% to put down. That's not the case at all. Maybe you might need to put that much down in order to qualify for the type of loan that you want. Or you might have special circumstances that would require 20%, but generally speaking, you know, if you can do 3%, 5%, you can get in. And then as Mike was talking about, mortgage insurance is something that is generally required if you put less than 20% down. So your mortgage insurance monthly cost is going to be a little bit higher if you only put 3% or 5% down than if you put 15% down. And again, like we talked about earlier with having good credit, the better your credit is, the less your monthly mortgage insurance cost is going to be. The mortgage insurance companies are now taking that into consideration, which is wonderful. And conventional loans are very credit score driven, just like I showed you that grid with, you know, 720 to 740 and then down to 740 to 760. That all can make a difference in what your interest rate is going to be and the type of how you would qualify for the conventional loan. The sensitivity to the maximum credit, the maximum debt to income is the 45 to 50%, but it's kind of like it goes into this scoring model of all things. It looks at your credit scores. It looks at how much you have in assets. It looks at, you know, what your debt load is, how long you've been on your job. You may not be able to go to 45%. It may kick back and say you can only do 42% because of all of the other factors. Remember, they're looking at what your risk is. Typically with a conventional loan, they're going to want 2 months of your total mortgage payment in reserves, but not always. If you have a good credit file, they may not even require that.
Diane, would you recommend that if somebody is looking to get a mortgage in the next 3 to 6 months, that maybe getting a side hustle would help? Does that help in the process?
It's not going to help you for qualifying because they can't use that income because you
Okay.
need to do history. But I was just talking to a friend earlier today and she's like, you know what? I decided to Uber. No, not Uber Eats. She's doing Uber Eats. And she's like, I can't believe it. I made $100 in like a half a day. So yeah, I mean, what the heck? Why not? But what you'll want to do, especially if you're going to use that money for, you know, down payment and closing costs, then I would suggest like open up a separate account, put those deposits in consistently so that we can document where did that money come from and all of the paper trail and stuff like that too. And then also keep track of your mileage because that's a write-off. But no, I think that's a great idea. Yeah, I mean, it's a great idea to do some savings, but we can't use it for qualifying until you have a 2-year history. And then the seller assistance, depending on how much you're putting down, you can ask the seller for from between 3 to 6% to help. That's percentage of the sales price. So in other words, if your sales price is 200,000, 3% would be $6,000 that they could help towards your closing costs. So that would be a nice help. Next, another type of loan is FHA. Have not done a bunch of these lately. Unfortunately, I have done tons and probably thousands of them in my history, but it's been such a competitive market that the mindset is it's a government loan. It's going to be harder to process. And sellers are like, I'd rather not. I'd rather take a conventional appraisal. FHA is going to be a little tighter on the appraisals, but the good news is I think the market is shifting a little bit. So I've been doing a couple more of these. The minimum down on this product is 3.5. You don't have to be a first-time home buyer to do an FHA loan. Typically their interest rate on FHAs are a little bit less than conventional, and it's not as totally credit score driven like it is for a conventional loan. You have a little bit more leeway. In other words, you can get a better interest rate if your credit scores are lower than if we compared it, if you have that same lower score with a conventional loan. The monthly mortgage insurance, as we were talking, as Mike had asked earlier about the private mortgage insurance going away, on a conventional loan, eventually it will, once you have 20% equity in the house. But for an FHA loan, unless you put 10% down, that monthly PMI stays for the life of the loan. Now, just recently, FHA did a really good thing and reduced the monthly cost. It was a 0.75% factor. Now it's only 50% factor of calculation of the loan, of your loan amount. So the good news is the monthly PMI is going to be a little less for FHA loans. And again, like we were talking about, they're more forgiving regarding credit and debt to income. So if I have a customer, let's just say that maybe is like a 670 credit score, and maybe the interest rate is really high and I'm having a hard time getting them approved at the amount that they want to get pre-approved for, I may flip it over to trying it as an FHA loan, and it may be a little bit easier just because of the guidelines. And what's nice about FHA is they will allow, regardless of down payment, they'll let the seller pay up to 6% of the sales price towards the closing costs. So that is really helpful, especially for first-time home buyers that may not have a lot of cash but could totally afford the payment. All right, next, under types of loans, if there's any veterans out there, a VA loan is awesome. It's one of my favorites. Minimum down is 0%. They do have kind of what's called the PMI, or the mortgage insurance, but it's called a funding fee. And it's basically a lump sum that's added to your loan amount. So you don't have a monthly cost. It's just added to your original loan balance, which is, makes it a lot more affordable. And for disabled veterans, they waive the funding fee, which is awesome. They do also allow, if you can negotiate it, the seller to pay all of your closing costs, all of your prepaids. So it really is like a no cash to close deal. So I've done so many of these, not a lot recently because of the government loan thing and so many cash buyers out there, but it is a wonderful program. So if you know a veteran and they are renting, tell them to stop it. Tell them to explore if they have an interest in owning a home. I mean, it just, because rents are so high right now, and there's options out there. And I think as the market changes, sellers are going to be more open to government loans and getting more people into houses. Now, the appraisal system is completely different. We don't manage the process at all. We go to a VA website, and they're the ones that order the appraisers and take care of all of that. So we don't have like any communication with the VA appraisers at all. And they can tend to be a little bit more particular because their goal is to protect the veteran, and it's a 0% down loan program. So, they are going to want to make sure if there is chipping and peeling paint, or cracked sidewalks, or dampness in the basement, they're going to be more particular, and they're going to want those things fixed before closing. So important questions. We're getting down towards the end here. These are some important things that you should think about, and that when you're talking with your lender, they should be asking you these questions. First of all, like, what is your comfort level for your new mortgage payment? And it really surprises me. Some people haven't even really thought about it. Well, think about it. Like, you want to look at, what is your budget? If you want to buy a house and you know that paying, $2,000 a month in rent is easy peasy, then how much more extra do you have every month in order to buy the more, have a $250 or $2,500 a month payment? So you want to look at, what is your comfort level? Because us determining for you if you can afford this, you don't want us to decide. You want to decide what you feel comfortable with. And how much money do you plan to spend up front on this home purchase? Like, you want to kind of have, like Mike had said earlier, put your ducks in a row. If you have maybe 10 grand and you have, you think that maybe your family will give you another 10, find out earlier in the process, just so you know how much you have available. And maybe you have hundreds of thousands of dollars in the bank, but you want to think like, okay, how much of this money do I want to put towards this transaction? Because you might want to save it for other things. What are your timing needs? How soon are you going to be doing this? You know, when do you need to be out of your apartment? You want to buy that second home before the end before the end of summer, like, because that helps to think about, okay, what do we need to do about the rates? How do we need to anticipate those things? What is your comfort level with interest rate risk? At First National, we have awesome adjustable rate loan programs. And what that means is, I think, and generally we've been speaking about like maybe just like a regular conventional 30-year fixed loans. But for an adjustable rate, it's a little bit lower interest rate, generally speaking, depending on the market. But it's a little bit lower, but the rate is only fixed for a shorter period of time. So let's just talk about what I love is like we have a 10-year adjustable rate product. It's amortized over 30 years, but the rate is fixed only for 10. And then at the end of that 10 years, which is 120 payments, at the end of that 10 years, then it turns into a rate depending on whatever the market is doing. And then with our product, it changes every 6 months after that. We don't have any prepayment penalty, but know that you may be like, okay, no, I don't want to take that risk, even though I might be saving a little bit in my monthly payment. That doesn't sound good. Or you might be like, hey, I'm all over that. Can we do a 5-year adjustable? Because I know I'm out of here in 3 years. Give me the lower payment. I don't care about, I'm not worried about that risk. I'll refinance when the time comes or whatever. So you want to know that about yourself. And then again, like I was just saying, how long do you plan on keeping the house? If you know you're going to be out of there soon, I work with, physicians and they know that they're going to be moving into a different area and they might just be here for a short time. It makes sense for them to, explore all of their options instead of just one particular area. So the lender that you're talking to, ask them, what else? What else do you have for me? What else should I be thinking about? What questions didn't I ask that I should be asking? With technology nowadays, it's so easy to just, put it in, ping, here's your pre-approval. And you want to make sure that you can trust that pre-approval, that you have a good dialogue with the lender that you're working with, that they have your back, that, they're there for you at 8 o'clock at night sometimes when you're nervous about, did I send you the right paperwork? So, who you work with matters. It's a big deal. So you want to think about it and not just necessarily using the technology, which is there and which is awesome, but also have conversations and feel comfortable. So I think that we are at the end. Ta-da!
Well, awesome. A lot of great information in there. We do have a question. Eric asks, what is the criteria for a no money down loan to buy a home in PA? Are there no money down loans other than the VA loans that we talked
Yeah, there are. And I have to say, it depends. From my experience, like I said, I've worked at several different, not several, a handful of three, four different places in the past 20 some years. But everybody has different criteria. I can tell you at First National, we do have a 0 down product. It would be based on your income. And then, or it can be based on where you're purchasing. In certain census tracts, that would be considered like low to moderate income, where we really want to help to increase home ownership in certain neighborhoods. Then we don't have an income limit. So it just depends on where you're wanting to buy and what your income is. And I know with our program, you don't have to be a first-time home buyer, but you can't own another piece of property at the time of application. So I think, definitely do some research, talk to different banks, different finance companies, because there's a lot of people that, lenders that do have opportunities for you, but you just kind of have to do the research to find out for sure. There's not just like one big blanket of zero down. Besides, everybody could do, the VA is pretty much standard with how it works. So
But I'm glad you mentioned the economically disadvantaged areas where lenders are looking to lend into. Are those areas something that you can share with a customer that they might be able to do a more targeted search for a home?
It's hard to say. You could just do some, research on your own, and just, there's so many websites and stuff like that out there. You can talk to, the way that I handle it with customers is when we're doing the pre-approval, we'll talk about that. And then they'll let me know, like, hey, we're really interested in this property. Does this fit? And then we have like the special website that we go to that we can search and then let you know, like, hey, this one is eligible. But it's so specific that it could literally be, Michael, like one side of the street, but not the other side of the street. And it's based on lots of census tract data, and then it could also be based on different minorities, what's considered a minority neighborhood. And that minority doesn't necessarily mean like your skin color or any race or any of that kind of stuff. It could just be if it's single parents. So I don't know how they determine that, but you can do sort of like a general idea and do some low to moderate checking in, like maybe the community that you're interested in, or if you really have like specific streets and areas and properties, then let me know and I'd be happy to research it for you.
Awesome. Well, I think those are all the questions that we have. Diane's contact information is there, and I'm sure that she would be happy to accept a reach out from you if you would like to talk to her about the product or additional questions that you might have. Is that okay, Diane? If folks reach out to you?
That's why I put it there. I'm happy to help.
All right.
I'm so grateful to be here, Michael. Thank you so much. I always have such a fun time with you.
Well, thank you. I appreciate you doing it too. It's a great message this time in the marketplace, right?
Yeah, definitely. It's always great to partner with you guys, and I love to work with your closing company.
Thank you.
And you guys do such a great job. You're on top of things, and you have the same mindset that that we do, that we care about the customer. We want it to be a smooth process. We want, home ownership is a big deal. Buying a house, if it's your first or your 100th, it's a big deal. It's stressful. So you want to work with people that care about it.
Yeah, absolutely. Have somebody that has your back, involved. I always advocate working directly with the lender. I'm not a big fan of brokers. I'm sorry if there are any brokers in the audience. I apologize in advance, but I think you should work. I'm a big relationship person. So form relationships, right? That's the best thing that you can do.
I agree.
Especially when it comes to banking and borrowing. You want to have good relationships.
Yeah, I agree.
All right. With that, Diane, thank you. Everybody, thank you for attending. We really appreciate that. We have other events coming up. You can check them out on our Eventbrite page, FIFIC Law Group. You search there on Eventbrite, you'll see some others coming up. I know that we have an estate planning webinar coming up on Thursday of this week at noon. And then we have our monthly Trusts 101 webinar coming up on the 22nd. So we hope to see you at one of those upcoming events. And with that, I will bid you all a great day. Thank you.
Thank you. Bye.
Bye-bye.